Good morning, everybody. Thanks for joining in. Welcome to the live and exclusive webinar on Option Express. Today, this is the live and exclusive webinar for the Option Express Part 2. Last week, we have covered some of the elements in the Option Express in Part 1, and this week we'll be covering a few more that were remaining in the Option Express. So let's dive onto the presentation, and let me just give you the overview of what we'll be covering in our presentation. So first of all, my name is Sumit Agarwal. I'm the Senior Product Manager for ICICI Securities, and I will be covering the second part of this Option Express, where we'll be covering the screeners, open interest. I will be explaining that in details and what is the significance of open interest, how it is read by the options trader, and what information you can get out of it in order to trade it. Next comes is the gainers and losers. These are nothing but the stocks that are gaining on a daily basis and losing on a daily basis, and these can also give quite a lot of information on the stocks that you want to trade in FNO. Next comes is the price calculator. This is a very handy tool for the options traders, where they want to understand what will be the price of a particular strike price, option price. Let's say, for example, in 2 days time, when the market reaches so and so number. So this price calculator is something that every options trader should know how to use it, how to calculate it, and this gives you enough information beforehand before you take the trade. So before you go into the trade, you should know what will happen if the market reaches at this particular point, and what will be your payout and what will be your the price of the particular option, basically. And this is used based on Black and Scholes model, and I will show you in detail how to calculate the price of an option using the calculator that we have available on the ICICIdirect platform. I will cover some more few option concept related to the delta, theta, gamma, and everything, so that you will get a recap of how options trading takes place using Option Express in ICICIdirect. So let me start with the the ICICIdirect platform. So give me a sec. Right. So you need to come onto the FNO. Over there, as I mentioned last time, there are two ways you can reach to the Option Express. First is going through the this plus sign, then click on the Option Express, which is blinking over here, and then coming down a little bit where you will see the smart option analysis available, and then you can click on the Option Express blinking over here. So whichever way you want to do it, you can go on to the Option Express easily. So once you click on that, the Option Express page will open up, and it will land you directly onto the scanners. So last week we covered strategy deck, we have covered option chain, we have covered scanners, and I think that's it. We covered in the last week. Let me give you a recap of what was covered in the last week, just to start with. So once you click on the strategy deck, you will be able to see the recommendations given by the based on the view. So here you have the opportunity to select whether you have above view, which means that above 15,993, which is the current market price, agree. And then if you want to select, you can select the range as well if you think the market is going to expire. So today is like 5th of July, and next week on 7th of July, you think the market is going to expire between 15,993 and 16,200, let's say. So all you need to do is that click on it, and then it will throw the strategies based on that. So the strategies it has given you is like short, straddle, short, strangle. And if you want to just go with the call, I mean short straddle, short strangle is going to have call inputs both. So again, with the expiry date, you want to select it based on the expiry that you want to trade. Again, the spread gap is the gap between the strike price, basically 15,800, 16,200 is like 400 gap. So here, if you want to select it like 400 gap, it will give you that number. The strategy based on that, and at the same time you'll be able to see profit that you will be making, and then the break even that you will be, you have to pass through that. And then you can simply click over here, you can see what you are selling. 15,800 is what you are selling put, and 16,200 call is what you are selling it. Then click on the payoff diagram and you'll be able to see the payoff chart for that, and then you can simply trade it directly from here basically. So that was all for the strategy deck, and you can even select the different scripts that you want to trade, and you can select the expiry date below, let's say 18,000, sorry, 16,000. It's not throwing any strategy for that. So yeah, so basically this is what you will be able to play with this strategy deck. Next was the option chain that we covered. So on the option chain, you will get the live feeds of the option chain where you will be able to trade it directly from the option. That's what the great feature about this option chain is in the Option Express. All you have to do is simply click on buy, then sell, and then buy again. You'll be able to trade directly from here, and just by clicking it, you'll be able to go through that. So on top of this, Option Express also gives you an option to see Greeks. So Greeks, here you will be able to see gamma, vega, theta. These are the Greeks available on the call side as well as on the put side, and you will be able to make use of this information, and you will be able to trade it. Lots of option traders, they want all this kind of information so that they can predict things beforehand before taking the trade. And these informations are quite important for the options trader, because all these the Greek values takes into account in order to compute the option price basically. So let me give you an overview of what the Greeks means, just to recap. So if you see, there are like 5 important Greeks option over here. So delta is nothing but the measure. It measures the change in option premium due to change in the underlying price. So what it means is, if 1 rupee change in the let's say ACC, if it changes by 1 rupee, then the delta of at the money is about 0.5. So if 1 rupee change in the underlying changes, the option price will change by 0.5 rupees. So if for a particular strike price of ACC, the price is rupees 10, let's say, and the option and the underlying price is let's say 100. So if it changes from 100 to 101, the 10 rupees will become 10.5 rupees if it goes on the upside. Similarly, if the delta is 0.5 and if the price of the underlying is 100 rupees, then that 10 rupees will become 9.5 rupees if the price of that ACC or that particular underlying drops by 1 rupee. So that's what the delta means basically. Similarly, for the gamma is nothing but it measures the change in delta due to change in the underlying price. So basically what happens is, as I gave you the example, if the price of that particular strike price, sorry, or the underlying, it increases by 1 rupees, the delta changes. How the delta changes? It changes because of gamma. So if there is a value, certain value of the gamma, which is normally given in 4 digits, so if it's 0.0012, that 0.0012 will get added to the delta. So that's how it will change. So if the delta is 0.5 and the market goes up, then 0.0012 will get added to that 0.5 delta. If the market goes down, then 0.0012 of that particular gamma will get added to the delta, because delta is going down, so the delta is going to be negative. So the gamma will get deducted from the delta, so the delta will drop down to, let's say, 49 point something 0.49 something or 0.48 something. So that was about the gamma. Similarly, theta, I think it is a very well-known Greek. Almost all of the options traders know it, because they trade it in order to expire a particular expiry, especially the out of the money traders. They want theta to decay very quickly, and theta is nothing but the time decay, and it impacts on the option prices, and it reduces as the time passes. So on a day 30, the theta could be, let's say, 100. On if there is if a particular option is going to expire in months time, so if there is only 1 week left for that particular option to expire, the theta will drop down to, let's say, 20 or 30 or 40 odd rupees. And if there is only 2 or 3 days left, then the theta of that particular option will be, let's say, 15 or 20 rupees. So let me show you directly onto our here in the option chain. So for current, the market price is about 15,800, 900. So here it is 850, 900, let's say. So 16,000, let's say, let's talk about 16,000. So here the theta is about what, 24.881 rupees. So at the moment there is like 2 more days left. So tomorrow, if you come and see, this 24 will be dropped down by, let's say, another 15, another 10, 12 rupees or something like that. So every day, when every day passes, the theta will keep dropping. So that's theta. Another one is Vega, which measures the option premium because of the change in the market implied volatility. So what it means is, implied volatility is the present perception of the market, and it is calculated based on trial and error method using Black-Scholes formula. So once you arrive at a implied volatility, what Vega means is, so basically implied volatility is given in percentage and Vega is given in rupees. This is the two most important thing that you need to understand. Implied volatility is given in percentage, and Vega is given in rupees. So what it means is, for 16,000, if implied volatility increases by 1%, so from 16.31, if it goes to 17.31, what it means is the price of this option, which is showing 97.5, will increase by 5.78%. So that's what it means. So if the perception of the market changes, whether market is dropping or going up, it depends upon the market perception. The implied volatility changes continuously on a daily basis, and on every second by second basis as well. So if it goes from 16 to 17, the price of that option will increase by 5.7 rupees. So that's what it means. And if it drops from 16 to 15, the price of that particular option will drop by 5.7 rupees. So these goes hand in hand with the Vega. And Rho is the interest rate available in the market, which is, I believe, on the NSE website, it is given as 10%. So that is constant at the moment. And it is used to calculate, it is used as one of the parameters in the Black-Scholes model to calculate the Rho, to calculate the option prices. So that was it for the option chain. Let me see if I've missed anything else. Yes, the another one is analysis. We have already provided you, which is OP means overpriced and UP means underpriced. OP is overpriced, which means that suppose a strike price of, let's say, 16,000, 16,000, the price of this option on the put side is 124, and what it says is underpriced, which means the price of this particular option was supposed to be a little bit more, but it is trading at it is trading cheaper. So what traders understand from this is that because this is slightly cheaper than what it was supposed to be, you can simply click on buy here and you can buy it. And because there is a tendency of the market to revert back to mean, it is expected, it is not certain, but it is expected that the price of this particular option will find its equilibrium value. How much, by how much it is cheaper or expensive, that is something that you'll have to calculate based on options price calculator, and then you'll be able to identify what the market is telling and what the theoretical price should be, basically. So that's where the price calculator comes handy. That's what the analysis says. So strategy we have covered, option chain we have covered. Last week we covered scanners as well. So in scanners, we had bullish, bearish strategies available for all the stocks available out there in the market. Neutral strategies also were available for the stocks and the indices. Indices, we have Nifty and Bank Nifty, where you can see all the strike price that are trading, and then you can filter this based on the highest volume, based on highest OI lags, OI change, implied volatility change, and so on and so forth. So you'll be able to get all the information related to Nifty and Bank Nifty, and especially the options trader. They want to understand how the implied volatility is changing over the yesterday, how the delta is changing, how the theoretical price is changing, because these are all the information that you need to track on a daily basis to understand the behavior of the particular instrument. So there are plenty of traders out there who keep trading Nifty and Bank Nifty, and they are like, kind of they have understood this particular stocks in and out by continuously watching and observing and analyzing these information on a daily basis, and they keep track of it to understand the behavior, how it is changing on a daily basis. So for options trader, these kind of informations are very handy. Once you get a hold of this information and you make a good inference out of it, you'll be able to trade it profitably on a regular basis, and you will be one step ahead of the market. Basically, you can be one step ahead of the market. Similarly, for the IB scanners, you can get information on implied volatility for all the scripts available out there. You will be able to see what the implied volatility is going on at the moment, uh, and the volume that you want to see, the bid price and the ask price. And at the same time, if you want to trade directly from here, you will be able to trade it. And it is giving you the theoretical price as well, which is theoretically it should be 187, but at the moment you can see the price is between 137 and ask price is 255, which is quite a wide difference, because this might be very illiquid. So what we need to do, yeah, exactly, because the volume that you say seen over there was just only one. So let me come up with the high volume stuff. Here you will be able to see this like 10.8 and 10.9. This is very close, right? Bid price and ask price, and the theoretical price it says is like 12.1. So the difference here is about 1.1 rupees. So for this particular one, VEDL 28 July 2020, sorry, 220 is the strike price. So this tells you that this is slightly going cheaper based on the theoretical value. So traders who want to trade this, they can simply just click on buy, and they will be able to go through the buy journey on that. So let me go back to the option expense once again. So that was IB scanners. Similarly, premium and discount. It gives you which particular future is actually going premium and which is is running in discount. So you will be able to see over here last traded price, percentage change, and it is premium. It's just by 5%, it is in the premium. And similarly, if you want to see the other ones, you'll be able to identify this is getting expensive by 4.3 rupees. So whether you want to short it, you can go ahead with this if you want to short this particular trend. Similarly for the Tata Steel, this is slightly expensive by 3.2 rupees. So the traders out there in the market who would like to trade futures will short this, and when it finds equilibrium, you will be able to see this price dropping. It will come to very lesser amount, just like 0.5 or 0.15. So this is quite close to what the price it was supposed to be. So that's the premium and discount for the futures. Similarly, you will be able to identify which stock is having lots and lots of buying happening, where the selling is happening, where the long unwinding and short covering are happening. You'll be able to identify this. Long buildup is the people who are buying aggressively short, and in those particular stock, the price is going actually up and up. Similarly, for the short buildup, people are trying to sell a lot, and that's why the price will be going downwards direction. And so sellers are aggressive in these kind of stocks. Short covering is the people who have actually taken a short position are trying to square off their position. So in other words, it is also called a short covering. Similarly, for the long winding, people who have taken the long position are trying to square off their long position. So they are trying to unwind this their long position basically. So that is the long build-up, short build-up, short covering, and long unwinding. Most active option, as the name explains, these are the options which are highly getting traded based on the volume and then based on the OI change information that you will be able to see. So Indian Oil Company, Indian Oil Corporations, I'm getting OI change information is not populating. It is coming for some, but yeah. So similarly, if I put, yeah, so if I take a put, you will be able to see that these are the strike price are getting traded hugely, and OI change and OI percentage change, you will be able to observe it over here for the this IOC particular strike price of 76, 75.35, and 78, and so on and so forth. Next is OI limit. Open interest is something that I'm going to cover this in this video. So let me come on to my presentation. So to give you, I think I have already covered this in the last webinar, and I will cover this again. Open interest is built by when someone buys and the opposite party sells it, and if there is one contract available in the market, that is called as total OI of 1. And similarly, on day 2, if somebody else buys it 5 contract and one more candidate sells 5 contract, then the total open interest in the market is like 6. So the 1 from the previous day and the 5 from today. So altogether the open interest is 6. On day 3, now the open position that you already have, the A already has, if he wants to square that off with the same B, suppose B or anybody else, and even B wants to sell the 1 quantity, then from the total open interest it will get reduced from it, so it will drop down to 5. And the same if C wants to sell only 3 contracts, and D wants to sell or square off his 3 contracts, then the total open interest in the market will drop down to 2. So that's how the fluctuation of open interest, it keeps going up, it keeps going down. And for the option traders, this is not just going up and down, they are trying to make some inference out of it, why the open interest is going up, why the open interest is going down. So it gives some valuable information to the options traders. So what information that they get is, so if open interest is increasing, the option price, if it also increases, what it says is that people are aggressive on the long side. Basically what they are doing is they are aggressively buying on the call side or the put side, whichever way you want to see it as. If this is happening on the call side, then it will be long build up on the call side. What it says is more people are actually trying to buy that particular call or put. Similarly, if open interest is decreasing and the option price of that call or put is decreasing, then the inference what you get is that people who have taken the long position are actually trying to square off their position. So it is also called as long unwinding. So longs are covering their position, basically they are trying to square off their bought position, whether it was call or put. Similarly, if the open interest is increasing and the option price is decreasing, so what it happens is your open people are having increasing their trades. So that means that people are actually shorting, they are more aggressive on the short side basically. So all they are doing is they are trying to aggressively short the the call basically. So if the call is having like 100 rupees or 150 rupees, they're just trying to short it continuously. So the basically they are trying to open the contract by initiating a short for that particular call. So that's why shorting is getting aggressive in this particular third scenario basically. Similarly, for the last scenario, if open interest is decreasing, which means decreasing means people are actually winding up their position. So if they're winding up their position, which means that and if the option price is increasing, it means it is they are covering the short. So the people who have taken the short position in call or put, they are trying to just squaring off their position, and which means that the market is going. Market is gonna go up because people are actually trying to buy basically. Next is active stock by PCR. So PCR is put to call ratio. All you have to do is just take the total of either the open interest or the volume in the option chain. Let me just click on the option chain. So all you need to do is you need to add all these open interest right from top to bottom, take the ratio of call with respect to put, and then you will get that put to call ratio. Scanners. So put to call ratio, you will get that information, and if the PCR is greater than 1, then it is expected that the market is going to fall, and if it is low, then market is expected to rise. It is also called as a contrarian indicator, not necessarily what I've just told you. It could be the otherwise as well, because it goes both ways. Because people think that the price is overpriced at the moment, so they tend to short it, and some people think because it is in a continual direction, it will keep moving up. So it goes both ways for the PCR. So it depends upon the trader how he looks at it. Gap up, gap down is something that you already know, that the stocks that have actually gapped up and gapped down basically from previous day. So these are the stocks that will come up as a gap up, gap down. So I think I have covered from the I've given you a brief recap of what we did in the last week. So now for this particular one, I will start with the screeners. Screeners you will also get let me type Nifty, and you will be able to select all these automobiles, banks, and you'll be able to see some values over here. It's not showing at the moment. It's coming up. I'm sorry about this. It looks like it's not working at the moment. Right. So for the IV range, minimum IV that you want to filter it, let's say from 40 to 80 is what you want to see. PCR range, you don't know how much you want. Let's say 1. Max PCR 1. Let's say future percentage change and everything. If you want to change and you want to filter based on those kind of numbers, you'll be able to do it from here. At the moment it's not showing any numbers, so let me put this as 20. Minimum PCR of 0.1, max PCR of let's say 1.9. It's not showing any numbers at the moment. Let me come back to this again. I think open interest is what I've already explained you right now. Right, at least this is loading up. So OI change versus strike. This is what the information that you will be getting handy, and that too in histogram format. For call, you will be able to see this in green, and for the put, you will be able to see it in red. And you'll be able to see on a strike basis what is the open interest available for that particular strike, and with the number of contracts available here. You can also see what is the total change in the call side and total change in the put side, while Nifty is at this particular market. Historical option chain is what you'll be able to see what has happened so far cumulatively, and you'll be able to see that 16,000 call is having about 2 million contracts. And similarly for the put side, you can see this 15,500, lots and lots of trading is happening in this particular strike price. And for the call, it's 16,000. So this is what information you will get. And as I gave you the example that you have to take the total of the open interest on the call side and take the total of the open interest on the put side, divide this by put to call, and you will get this particular number, which means that it is fairly 1.03. I would not call it as bullish, I wouldn't call it as bearish. This is market is presently stable at this particular number, but as the market or the day progresses, this number could change, because there could be the significant increase or decrease in the total calls and puts, because as I just mentioned, how the open interest it keeps increasing and decreasing throughout the day. So that was the open interest. Next comes is the price calculator. So this is a very important tool for the options trader. So let me just try with the Nifty. And the expiry date I want to select is, let's say, 7th of July, and the strike price 16,300, let's say 16,000. Let's go with the 16,000. My future target 16,000. What is it is going at the moment? So that's the at the money one. So let me go with 16,200. I'm going a little bit out of the money. My expectation is that the market will go up to 16,250 on, today is 5th, right? And by Thursday I think it will be 16,250, let's say. And if I submit this, so expected call and call PNL and put PNL on reaching a target of 16,250 on Thursday, right? So once, so that's what it says. So based on that, what is going to be my value of call and what is going to be the value of put on that particular day. So as of today, you will be able to see that this is what the information is available as of today right now. So call ka price will be 29.6, put is going to be 235, delta, theta, gamma, and all this information is available right now. But on that particular day, you will be able to see that the call will be having rupees 50 and put will be 0. And this is the current, as you can compare this with here. If you have taken a position of just 50 quantity, this is what going to be your profit, and this is what you will be losing. Similarly, if you would have shorted it, this is what you will be losing it, and this is what you will be gaining on the put side, basically. So that's how it gives you the information. If you want to change the the future price, let's say if I go with 16,300 and implied volatility of, let's say, 20, if I think if it goes that way, and you'll be able to see the change in the price as well. So you will see the call price has changed from 300 to 100. So if I change from 300 to, let's say, 400, call price has actually changed. And this is nothing but static at the moment. This is so that's how you will be able to predict the future for the options and what the price of that particular call. So if the market drops down to, let's say, 15,900, you can see the call will expire worthless and the put will be having some value over here. So that's how you'll be able to use this price calculator in detail. Here I put 0 days to expiry, and if there is, like, let's say 7. Okay, so it's not a table here. expiry, if I change the expiry date, 7 days to expiry is what it says, and then accordingly the price of that call input will change. So you can play around with the based on the number of days that are still remaining for expiry. So implied volatility at the moment is 18.5%, it says. And if you want to change the implied volatility, as I mentioned earlier, if what will happen if the price of that particular option will increase, sorry, implied volatility of that particular option increases by 1%. So from here 18.15 to 19.15, if I change, you will see the Vega is 4.9, and the price of the particular option will change by 1.9 rupees basically. Sorry, 4. It will add about 5 rupees in that particular call if it increases. Similarly, if it decreases, no, 16, I didn't remember exactly how much it was, 17 I guess. So it will drop down the price by 5 rupees or something, and that's how you will be able to play with this options calculator, and you'll be able to predict beforehand, before taking the position, what sort of strikes that you want to play with it, and what sort of the strategy that you want to deploy in the market. So that was it for the price calculator. The last is gainers and losers. This is a straightforward understanding. Lots of people, they understand this very quickly because there's nothing significant in here. All it says is what are the stocks, the futures that have gained from yesterday, and what all futures that have actually lose, and you will be able to analyze a little bit more based on the OI change, how much it has changed. If not, you can even understand it from OI change in lakhs, how much it has changed. So 7 lakh of open interest has actually dropped for this particular Coal India. Reliance 5.65 lakhs. So yeah, and if you want to trade it, you can even trade it directly from here. So this was actually for future stock. You can even do this for future index, where you'll be able to see for Nifty and Bank Nifty, option stock for all the option stocks available. It will give you the example on the strike prices that are actually uh, and then the option index, again Nifty and Bank Nifty, mid cap Nifty, Nifty Bank Nifty, Nifty, Bank Nifty, all. I mean, you will be able to trade, play with this directly from that. So I think that's it for both the part one and part two, because we have covered a lot of ground on the Option Express, right from strategy deck, option chain, screeners, scanners, open interest, price calculators. So I think all the information I think I have covered in details, and I've given you some explanation about how to make use of it. Uh, you can design your own strategies, you can come up with your own strategies based on that. If you want to trade it, there's one more product available as OneClick derivative, where our company ICICIdirect will give you the ready-made strategies available to you on our website, and you can come and trade directly all these strategies available. Bull call spread, bullish back spread, sell long call, then covered call. All these strategies are also available to you for free. You can simply come in here, you can trade it, or you can go through the Option Express. Even there we are giving you the strategy deck, where you can design your own based on your view. So all this information, all these tools are actually available to you for free. And for the options traders, you will need to go through these each and every tools in details to understand it and make the profitable trade basically. So yeah, so next is I'm open to the questions. If you have any questions, you can put that in the chat box, and I will take it one by one. So let me see if I have some questions here. Is this option chain available to everyone, including NRI? I think yes. Option chain is something that is available to to all of the people. It is available on our platform, and that too with no cost. You can simply come here, you can select the stock that you want, you can select the expiry that you want, click on Greeks if you are high-end options trader, if you want to trade based on that, and if you don't want to trade based on that, you can simply untick it, and it is all available to the people. um, how to Please explain how to buy options with the stop loss. So in all you need to do is go onto the FNO, go onto the place order, take an option. Option plus is intraday product, options is the positional product basically. So if you click here more, you will see the order validity and a stop loss. So basically, once you click here on the stop loss, you will be able to understand what is a stop loss order, how to, all these examples are actually given to the people available, who would like to trade it. But if you don't know how to use it, let me give you an example on this. So let me go here, NIFTY Nifty, 16,000. Let me go with the current market price, which is 16,000 call. So I want to buy it. So the current order market price is like 104, 105. It is changing continuously. You will be able to see it here. So margin required, it says, is 5,245. I have some amount available in my here, and I want to trade here. So at the moment, the market price is 106, and I want to make if I trade this here, I want to make a stop loss of, let's say, 90 rupees, and all I need to do is just place order. So what will happen is, once you place the order, if market goes up, you'll be making profit, but if it goes down, your trigger price is 90, and then once the trigger price is hit, it will execute at the market, and whatever the price that it will fill at, that will be a stop loss basically. So that's how you will be able to place stop loss using options. One thing I want to tell you here is, margin here is, you will be required for buying option is full, but if you go and trade onto the intraday option plus, what you read over here is you get the highest exposure, and margin required will be calculated on the basis of your stop loss price. You have to specify a stop loss at the time of taking your option position in this product. So for the intraday product, all you need to do is click here. You need to select, let me just explain you this once again. So 16,000. So over here it says the order type is 108.5. So if you multiply 50 by 108.5, 5,400 something will come up. But if you put a stop loss of, let's say, 98, so I'm putting a stop loss of 98. Let me go with 100 basically. Now what happens is, the difference between these two prices is about what, 9 rupees, right? So 9 rupees is what the difference, 9 5s are 45, which is about 450 rupees. So the system, what system does is, it will, so this is going to be a trigger price, and there is a possibility that you may get fill at 98, 97. It depends upon the market fluctuations, and the speed at that it is moving. So limit price comes here is about 88 rupees. So 88 to 108 is about what, 20 rupees, roughly around 20 rupees. So 2 5 10 is about 1,000 rupees. So this is what the margin you will be requiring in order to place this particular order. So this is a fantastic feature for intraday traders, where they don't want to spend full amount. If you want to go with buying it at the money options, which are slightly, slightly more expensive, and if you go, even if in the money, even that, and those are more expensive to buy, and you have to put the full amount. If I don't have a stop loss over here, let's say, so if I 16,000 call, if I don't have a stop loss over here, then all I have to do, it's not showing, it was just showing right now. Oh sorry, I haven't clicked on buy. limit price of 108. So you can see 100 quantities, 108 is about margin required is 10,800. But if I put a stop loss over here of 100, the limit order is calculated automatically based on certain number of percentage, and the margin required is only 2,000 rupees. That is what you need in your account. At the moment I have like 1800 rupees. So if I put my stop loss of, let's say, 104, so my limit price has actually gone up, so the margin required is now 1650. Now I will be able to place the order. So this is as simple as it is available. This is the new feature that we have added onto our system, and you'll be able to take advantage of this particular one. So stop loss. Do we have a trailing stop loss feature? It's not available at the moment, but then this is actually available for the futures under advanced orders. So you can come here, you can click on that feature I button over here, and you'll be able to read it how it works. So yeah, so this is available for the futures. Please explain how to buy options with the stop loss. I think I have already covered that. Please also explain how to trail stop loss in options. Trailing feature in the options is not available at the moment. And that's it, I think. Are there any questions? I think these are the only questions I've got. I think I have already explained you a couple of features that we have already introduced. So there is another feature that we have recently introduced is a basket order, where people will be able to, just so that we have time, I will create one basket and you will be able to analyze your basket order easily. So let me give you select contracts. Why it is not happening? Right, let me create a new basket altogether. Showing up at the moment for some reason. I am trying to locate right one. PCS. Enter at least first three. Why is it doing so? So we have actually introduced the analyzing feature on this particular one. The other one is on payoff analyzer. If you go over there, we type Nifty over here. Nifty, you can select the scenarios. Nifty, you can see the ATM volatility. You can see the range, add positions. So 18,000, 16,000, 16,000. I have bought. I want to sell 16. To sell 16,200. That's a 16,100. So I'm buying at 104. I want to sell it at 59. All I will do is just click on payoff analyzer and I will get this bull call spread. Once I'm satisfied with this, all I can do is simply just go and place order by naming the bull call spread. See, it will bring me to the basket order. All I have to see is the margin. All I need, the margin is 97,000. So the once the this is what I will need in my account. Once the order gets executed, this is what will be blocked from your account. So all I need to do is just simply go and place order and proceed, and then the orders will go through basically. So if I click here, At the moment, I don't have sufficient fund in my account, so it is telling me that it is insufficient. So that's it basically. In the meantime, if I've got any other question, can you please explain the custom one-click derivatives, because I didn't understand the purpose of it. Okay, so the one-click derivatives, may you have recommended ones and the custom one. Recommended one-click is the strategies that is given by the research analyst, the dedicated team that we have available in the ICICIdirect. So those people, they keep on analyzing on a real-time basis, and then they give you the recommendations. Custom one-click is something that you can design your own strategy basically. So let's say I create one. So bull call spread is what I want to create. A, B, C, D, and leg. Why it is not clicking? So basically, you should be, I'm not able to click for some reason. There's some issue going on at the moment. So that's what the one custom one click is. All you have to do is just come here, add some stocks that of your choice. Nifty, select contract. I have done that. $50 limit price, let's say 100, and like it's not happening at the moment for some reason. But yeah, the purpose of the custom one click is that if you want to come and design your own strategies, you will be able to do that on your own. All you need to do is just come here, recommended click will be available. Custom is something that you can design your own basically. I think that's it. There's no more questions available. So yes, we have covered the complete option express in part 1 and part 2. Most of the tools that traders want are available within the option express, and there are plenty of other tools that are actually available on the ICICIdirect platform as well in order to trade. Margin facility that you can you can see the margin benefit that can be applied using the basket order. You can analyze your trade using the payoff analyzer. On the option express, you can even trade directly from the option chain. There's a strategy deck that gives you the recommendation, and plenty of the information related to implied volatility, volume, gainers, losers, the maximum trade happening in that on which particular strike, and all information required is available on the option express. I would recommend all traders to keep using the price calculator of the option, because that is something that will help you to understand what will happen if market goes to XYZ number in next few days. So this will help you to generate the scenarios and give you the information beforehand before you take the trades. So happy trading, keep trading through ICICIdirect, and thank you very much.